great future.
We're talking real money.
Hey, thank you for being part of Talking Real Money here every week to help you better understand money, investing, how to spend it, how to save it, and how to have it grow for your future. I'm Tom Cock. Don McDonald has the day off as he visits his mom, which if we can do that, we all should do. So he should be praised for that. Or maybe he just got tired of being here every Saturday with me. I don't know. But he'll be back next Saturday. It's a holiday weekend, but we'll both be here to talk with you about money. And if you have any of those questions, I'd love to be the guy that talks to you. 855-935-TALK. It's a little less crowded in here. Maybe you can get a few more words in edgewise. 855-935-8255. And before we get to the calls, and I want to thank Rich for hanging on. We'll get to you in just a couple minutes here. But all this discussion about alternatives and private investments and non-traditional assets and this stuff that the president has now signed an order allowing 401ks to put this into their plans, which you've heard me before say I do not favor. I don't think it's something you need, and I don't think it's something you want to invest in. But it brings beyond the risk of those investments, and by their very nature, they need to be riskier than publicly traded investments, right? Because these are things that have locked up your money and you can't get at it. That's the part that I think people have a tendency to forget. And you're seeing that now. And an interesting piece, if you're a reader of the Wall Street Journal, Jason Zweig, who's one of our favorite writers, yesterday came out with a piece that talked about major colleges and universities with endowments of $5 billion or greater have 2/3 of their money in these alternatives, private funds, non-traditional assets. And guess what's going on right now with the president threatening to cut off their funding? These elite institutions such as Brown, Columbia, Cornell, Harvard, Northwestern are having to go out and borrow money, even though, listen to these endowment sizes. I had no idea that they'd gotten this big. It's the Harvard has an endowment of $50 billion. Northwestern, $14.3 billion, but they don't have enough to come up with $500 million. Now, some of the endowments obviously can only pay certain things. They can't pay into the general fund. I get that. Okay. But that's a lot. So these colleges and universities have been running around borrowing money, borrowing $500 million here and $700. I mean, we're talking about real money. And this is something that they faced not that long ago in 2008, 2009. Yeah, they also were in a cash crunch because the problem with these alternatives is even tougher than the public markets, because no matter what happens in the public market, there's still a market for that security. Now, it may pay you far less than it did as you get into 2008 than you paid for it in 2006 or 7, but at least you could get it. I think that the thing about these alternatives is the whole aspect of why liquidity is so important, why you need to keep things you could sell tomorrow and take your money and go to wherever you're going to go to. And that becomes even more important when you retire, right? Because you need things that are going to pay you in retirement. This is the part people forget about. They look at their investments like, well, this part, the stock part, only goes up. Well, until it goes down, but it makes a lot more money than that other stuff. The bonds. Yeah, because bonds have a guaranteed nature to them, right? These are securities that there's an IOU, there's a piece of paper that said you'll pay you back. You get none of those sort of things from stocks. Absolutely 100% no. So retirement income is going to be important. Any emergencies that come along, those are going to be important. You got to be able to meet those, just like these schools are facing today. And here's the other part that I think people forget about liquidity is peace of mind. I talk to many people, especially in their 50s and 60s, and they say, I got a couple 100,000 in CDs. Why? Well, because I don't know what could be around the corner. I want to make sure I'm able to pay the bill. So keep that liquidity. Pay attention to all these things, especially as you get closer to retirement. 855-935-TALK. We'll take your questions and call straight ahead on Talking Real Money. 855-935-8255 as we continue Talking Real Money.
suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more detail.
Your guides to a really great financial future. Tom and Don are talking real money.
Thank you for joining us here on Talking Real Money. Our telephone number, we're going to get to the phones now, 855-935-TALK. That's 855-935-8255. Let's go back east. Will, thank you for being a part of Talking Real Money. How are you? Will, do you have the will to... Will, there you are. It's Tom. How are you? Will?
Are you talking to me?
Yes, it's you, man. You're on the air. How can we help today?
Oh, yeah. My name is Rich.
Okay, Rich, my apologies.
Question.
Yes.
No problem. My wife and I'm 57, she's 56. We have $2 million right now in our combined retirement assets. And at 65, I'm going to get a pension of $80,000. And I just purchased an annuity, the North American Income Pro 10. What it's going to do is, the 10 years, it's going to credit. I put $100,000 in. It's going to credit me 8% a year for 10 years. Then after 10 years, I could draw out 6.5% of the $214,000, which is what it's going to grow to. And that'll, for my wife and I, is income. Now, I would like to put another $150,000 of this $2 million into it, because I don't like the idea of uncertainty. And I know there's the whole, you got the 3% rule, 4% rule, diversified, however, I want my bills, I want that monthly check coming in. And I was just wondering your thoughts on a deferred income annuity.
I don't favor them, but let's talk about your situation outside. Let's just step back just for a moment so I'm understanding your overall situation. $80,000 in the pension. Are you going to be eligible for Social Security as well?
Yes.
Okay, so you're going to be eligible, and then your wife, I think you mentioned. So there's 3 pensions, basically, right? There's 3 fixed sets of income. How much of your income will that cover? I mean, how much of your income needs will those 3 regular payouts cover?
Well, ideally, I would like $10,000 take home a month.
Okay, but I mean, so your pension alone is not much, though. I mean, that's the thing. I mean, so I get the certainty thing. Here's what I would do if I had to have certainty. If I just said, I don't want to mess with it, I want to know the bills are paid, I would wait until I retired and just buy an immediate annuity, because you can buy those for almost nothing. There's you can buy them commission free, and it's going to give you a little bit of interest, but it's going to pay you back your money for the next however long period you want.
I know. The thing is, though, I can't find anything. I put in, I tweaked some, dates of birth to see, and nothing will guarantee me 8% a year.
That's okay. And we need to get back to that 8%. Yeah. Yeah. I mean, this is the struggle. It's not an 8% growth per year.
Well, they're going to credit my money. I put 100 in. It's going to go to 214. If I want to liquidate it, listen, I can't liquidate it for $214,000. Then the insurance company is not going to do that. I bought it strictly for income, and I can't find anything that could give me 6.5% withdrawal rate on a $214,000.
I don't believe it.
I have it. It's in writing.
Yeah, I'd have to see it.
It's, the GL.
I'd have to see what the cost of that is. How much are you paying?
Mm-hmm.
I'd have to look at all those factors.
1.3.
Yeah. And do you have any riders on it?
If I was paying, that's the rider. It's the guaranteed lifetime withdrawal benefit.
Okay. And I'm not looking for an argument here, but if you're asking my opinion, I'm telling you I don't think it's a good idea. No. Especially in your situation where you already have 3 sources of guaranteed income. I would simply say, how much do I need to cover for the rest of it so everything is paid? I don't worry about it. I would retire, give it to an insurance company for an immediate annuity, have them pay out whatever I needed. Because I don't trust these other products. Earlier, last hour, we just had a call from somebody else who did a similar sort of thing. And she said it's the worst decision she's ever made. That's generally what we hear from people. This isn't because I hate insurance people. That's Don's deal. It isn't because I hate other products. I don't hate everything else. I'm just trying to be realistic here. So I appreciate the call, Rich. But again, if you're asking me my opinion there, I would not buy that product. I would not, and it certainly wouldn't add to it. Let's go back to the phones. And I think I had this wrong last time, but we'll try it again this time. Will, thank you for being part of Talking Real Money.
Hey, Tom, it's Will.
How are we doing?
Fairfax County. How are you?
Very well, sir.
I'm just wanting to check in. I'm looking forward to possible conversation in September with you. I was watching a music video, and I thought that it was Don McDonald.
I hope not. As long as he wasn't dancing or anything, it's okay. So, yeah, I guess that's all right.
It was Reclaw and Drake Milligan.
Yeah.
And it ended up, I looked at it, it was Chris McDonald.
Okay, I was going to say.
Financial, but are they related in any way?
No, they're not. Don does do some moonlighting, but it's not that kind. He got in trouble enough when he did the political thing a few years ago that really blew up into a national controversy when he got it. What was it, pudding fingers or something? I'm not supposed to even talk about it because it turned into such a kerfuffle.
Chris McDonald was wearing a hat in the video, and at first I thought, this is how familiar I am. I thought I was looking at Don.
Yeah, well, so go ahead.
Yes?
Go ahead. What's your question?
My question is, they had that lawsuit for real estate a few years ago. How much should we budget now for our when we sell our first townhome?
Yeah, I mean, that's a fascinating topic because I just read in the local business journal that actually commission rates have gone up in the last year since the settlement. It's fascinating. I generally, when I look at real estate, I say the seller's going to pay somewhere between 8 and 10% of the price to get to unload it. That includes the commission, taxes, all the other stuff that goes into it. So and when I run it for myself, I usually run it at about 10%.
Awesome.
It's not fun. By the way, that stuff's deductible. So if you have a gain, then you're going to be able to write that off. So, and this gets back, by the way, it's a fascinating thing, Will. You ever heard us talk about this? That people believe that, I get rich owning a home. I bought a home, how many years ago? 2007 that I owned until last year, 17 years. Remember, I think I talked about this on the show and the podcast. And this is a great market, Seattle. And it ended up, the ROI was something like 3 to 4%. It was not crazy good because you got to do all the stuff to take care of the place. You got to pay the interest on the note that you got. And then when I went to sell it, you got to pay the people to sell it. You got to pay the government for the taxes. It wasn't as great as you might have thought. So no, I don't know the market in Fairfax County, but think about all those things carefully before you get into real estate as a big return on your investment. I'll put it that way.
Yeah, it's just our first time we bought in 2002. It's time to relocate.
All right. Well, you go relocate. We're going to relocate to a break here. Thank you for joining us, Will. It's a pleasure. 855-935-TALK, 855-935-8255. We'll be back more talking real money.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Thanks for being part of the program. I do want to just very gently go back to the end of the call with Rich. I hate cutting people off. I'm not in the business of doing that. I try to take every question, answer them as honestly as I can. But when you talk about, for example, 8% growth inside of the portfolio that's guaranteed, I worry when I hear that number, because think that through for just a minute, stepping back. If that were indeed true, don't you think I would take all of my clients' money? I mean, we manage like $1.2 billion here in the Northwest. I just put it into that. Because why would I take the chance of stocks and bonds? It doesn't make sense. If I can just get it on, if I just hand the money to somebody and they send us back 8%, that's why I get nervous when people give me those kind of numbers like that. That's easy. I wonder if it's really that easy. So Rich, I appreciate the call. And again, I don't like sort of telling people they got to get off the phone. And I'm happy always to discuss things, but that's my rationale there. Let's go back to the phones at 855-935-TALK. And by the way, we've got room to take your call still before the program expires in half an hour. Catherine joins us from beautiful Bellevue, Washington. Hi, Catherine.
Hi, Tom. My question is, I've been studying Vanguard ETFs, and I was curious why they don't have any balanced Vanguard ETFs.
So they have yet to
go elsewhere?
Yeah. So I'm just curious because the Vanguard Balanced Index Fund, VBIAX, is a fund that I do recommend to people many times. And this is a fund, it's because it's great to own, because it has about 60% in stocks. It's only U.S. stocks, but it's fairly diversified, and then 40% in bonds. You don't have to do anything about that. I'm just looking here to see if indeed that is, you're right. I don't see an ETF. I would be surprised if that wasn't on the drawing. I'm just looking through Vanguard's list here of exchange traded funds to see what they may have that would be like that, because Vanguard's been among the leaders both in terms of rolling out ETFs and taking, funds that they have, mutual funds, and turning them into ETFs. I'm trying to find here. I see extended market, financials, the FTSE, the emerging markets. They got a lot of growth ETF, intermediate term bond, large cap ETF. Wow. They got materials ETF.
Would I have to go to target date funds? Would I have to go to target date funds to find a balanced fund that looks like it would be balanced?
Yeah, I'm not even sure if I see target date funds here I'm just trying to go through their whole list, which is lengthy. Is this in a retirement type account or is it in a regular brokerage account?
It's regular brokerage.
Yeah. I don't favor target date funds in brokerage accounts. Vanguard had a huge problem a few years ago when they had to sell a bunch of stuff and people that were left holding the bag had a huge tax bill. Maybe you remember that. I'm just trying to think of the best. I mean, one thing you could do, of course, at Vanguard would just be take 60% of the money and put it in VT and 40% of the money in BND. Build your own little balanced portfolio there that would be, pretty doggone good. And then once a year you wake up and you say, that would be a little trickier from the tax perspective, but then you could, if you had to, sell a little bit of one and buy the other one, or if you're adding money to that, you could add to the one that hadn't gone up as much. But I don't see that on the list. I'll be surprised, by the way, if it isn't soon, because Vanguard, as I said, has been a leader in this field. I suspect that they will be into the future, and they've been really good at meeting consumer demand. And I'd have to look around a little bit, Catherine, too, to see if anybody else has one, whether it be Fidelity or Schwab, perhaps, might have a balanced exchange-traded fund as well. Thank you for your call, and my absolute best of luck to you. I'm a Bellevue guy too, so I can say beautiful Bellevue, having been a Bellevue High School graduate. Not going to give the year because people are going to wonder if they really had a school at that point, but it's going back a few years now. Let's put it this way. We have a big anniversary coming up next year. We'll just leave it at that. So if you have a question, anything money related, you can join the program. 855-935-TALK. That's 855-935-8255. Taking calls from all across the country today. Minnesota, Texas, Virginia, Maryland, let's see, Bellingham, North Carolina, Bellevue. So any of those places have called us, all of those places, and you could be the next person on board. If you want more help all the way, you can always go to talkingrealmoney.com and click on either meet an advisor if you want some one-on-one help, or contact us if you want to ask a question. So 855-935-TALK, 855-935-8255 as we continue talking real money.
We're talking real money.
Hey, thank you for being part of Talking Real Money. We are here every Saturday for live questions. If you want to ask us one without a lot of people listening, you can go to our website, talkingrealmoney.com, click on Contact Us. You can type a question, which will be answered at a later date. We've got a few of those here. And you can also record one that Don uses on Friday. So be a little shy if you like. If you don't want to have anybody know what your business at all, period, well, you can go to talkingrealmoney.com, click on Meet an Advisor. Yeah, we'll talk to you. We'll help you look at your situation, try to give you some observations that you may not be aware of. So all those things here to help. And today, that's right, we still have time to get you on the air right now if you'd like. 855-935-TALK. That's 855-935-8255. Call now. We've got lines open. You know, one of the things we preach pretty regularly, quite a bit, is building the right portfolio and then leaving it alone. Maybe rebalancing from time to time, sort of selling the things that have gone up and buying the things that have gone down, but otherwise not paying attention to the noise. And there's always I think there's more than there ever been, because you got the internet, you got television, you got newspaper, et cetera, social media, and the number of people, young people, that now get their investment advice from TikTok et al., to me is staggering. But the lessons from not paying attention to people on TikTok, to tuning out the noise, to not doing anything when it looks horrible. And we have a pretty clear example this year. This from our friend Larry Swedroe, who wrote yesterday that on April 8th, Bridgeway, which is a fund family, their U.S. small value exchange traded fund closed at $16.84. Yesterday, 2.5 months later, closed at $22.72. That's up 35% in a couple of months. Dimensional, again, fund family. International Small Cap Value ETF closed at $25.47 on April 8th and closed yesterday at $35.28, up almost 39%. Swedroe writes, have to feel bad for those investors who panicked and sold after the Liberation Day rout, and congratulate those who stayed the course, adhering to their long-term plan. I will add one thing, Larry, and thank you for this comment. You got to make sure you own all these asset classes, because most people do not own U.S. small cap value stocks, which have been one of the best type of stock to own for a long period of time, and very few own international small cap value stocks. Crummy companies from risky countries is how I put it, but they paid you more. You gotta make sure your asset allocation covers all of those places, and then you build it, and you gotta be able to say, whatever comes is coming. I might rebalance, but I'm not going to get out when it looks bad. So that's really great stuff. So we're going to take a quick break here. When we come back, we will go back to the phones, and we will be talking to Joe in Bothell, and you, wherever you are, at 855-935-TALK, 855-935-8255, as we continue on this wonderful Saturday afternoon, talking real money.
Tom and Don are talking real money.
Do you you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey, thanks for being part of the program today. Before we go back to the phones at 855-935-8255, I want to mention, I mentioned a couple of funds that have rebounded so sharply from the April lows, but just to give you an idea, these are asset classes, types of stocks that have similar characteristics. International, that means overseas stocks, small cap, the smaller ones according to market valuation, considered value, are up 32% year to date. International value stocks, the bigger value stocks, up 30% year to date in a year which has seen the S&P 500 up about 10. Nothing wrong with the S&P 500. It's been a great place to be for a long time. And by the way, there's a lot of people think that we're sort of moving leadership to a different type of stock. I don't know anything about that. I just want to own all of them. So you want some reasons? You want to say, hey, I should own some of these? There's a reason for you. So let's go back to the telephones. As I mentioned, our number, 855-935-TALK, 855-935-8255. And from Bothell, Joe now joins us. Hi, Joe.
How you doing?
I am doing great. How can I help you today? Yes, sir. Go right ahead.
Well, I have a two-part question. The first part is around our investments. My wife and I are retired. We live off the income from our rental properties, and we have money in a 401k and a Roth. And we don't really need that money for income. We use it as discretionary type income. So my question to you is, because we're able to live off our real estate as retirees and not on Social Security yet, is it okay in your mind that we're just 100% the S&P 500, we're in Vanguard S&P 500 funds within the Roth and the 401k?
Well, okay, let's ask a few other questions, because if you're not going to need the money, right, if this is assets that can continue to grow, I'm going to say, well, sure, because you don't care if it goes up or down. But here's my question to you. Are you or your wife going to care if the value of those assets go down dramatically? For example, and we talked about this recently, the bear markets we've had, the last couple of them, really since 08, 09, have been, steep down, but turned around and gone right back up. What if we get in a big bad bear of a year and a half like we did in basically the fall of 07 till the spring of 2009, which saw stocks down 50%? How are you going to feel if you look at that portfolio that was whatever it is, fill in the blank, and it's now only half of that? Is that going to be okay?
Yeah, I'm fine with that. We're doing that right now. We're not taking any distributions out of it during this year or next year just because we're sort of regulating our income for, controlling insurance costs, because we're not eligible for Medicare yet. So we're retired young. So we're just, trying to control that income by just living off of the rental properties, which we're comfortable with. So the 401k and the Roth, we don't mind seeing it go up and down, just as long as it's up and down over time, up and to the right, I suppose, which is kind of the Fortune 500. So we don't depend on it. We just use it for discretionary spend. If it's been up and it makes sense to take some, that's what our plan is. And we've been a couple of times since we're retired early.
I've got no problem with that part of it. Here are my suggestions, twofold. Number one, I would urge you and your wife separately to take the risk quiz, which you can find at talkingrealmoney.com. It's free. You get a score. That'll help you understand yourself around money, because oftentimes people say, well, that's not going to be a problem if that goes down because I don't need the money. I know my wife, by the way, if she saw my portfolio, our portfolio, was half of what it is today, and she saw that number, it would be uncomfortable. That's one. I would, both of you take the risk quiz and then look at that. And if you need to talk to somebody about it, we're happy to do that. That'd be part one. Part two would be, I don't think anyone should have all of their equities in just the Standard & Poor's 500. The Standard & Poor's 500 is 500 of the largest companies in the United States. Feels safest, but you have tremendous concentration risk. I think the top 5 stocks make up about 20% of the portfolio. So you talk about up and to the right. You keep shoving more and more money at these companies that have done the best. I just mentioned international. I just mentioned small cap. I mentioned value, emerging markets, REITs, all these other things that you should have your money invested. And I'd rather see you be far more global. It'd be okay if you're okay with the ups and downs of the stock market to be 100% in stocks. But I'd prefer to see you spread it out to a portfolio of about 10,000 companies instead of 500. So I hope that helps you. Does that make sense, Joe?
Yeah, it does. And it's, I followed Paul Merriman's, which I think you are familiar with him. And he talks about small cap value and the S&P 500, a mix. You think that's a good place to go? Maybe in a 60-40 or an 80-20?
Well, again, if it was my money, I would have about 60% in U.S. stocks, 40% international. And then I'd divide it up between big and small and value and growth. And yes, I'm very familiar with Paul because I was a partner of his for many years, at what was then Merriman Financial, et cetera, et cetera. So, that would be a fine portfolio. But, to say Paul would sort of say your portfolio is okay, I don't think he would, because if you're just in large U.S. firms, you would, that wouldn't be the place to go. So, anyway, that would be my one big change. We've got to go to a break. We're going to come back and talk to Alan in Issaquah in just a couple of moments as we continue talking real money. If you want to try to squeeze one more call in, 855-935-TALK. If we can't get you on the air, you can go to talkingrealmoney.com. And of course, then you can, hit the contact us button and send us a question there. We'll answer it at a later time. So thank you very much for being part of the program. We will continue talking real money in just a moment.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
I want to thank you for joining us here on Talking Real Money. And we're here every weekend to do live calls. As I said, if you prefer not to do it that way, you can go to our website, can ask a question there. You can also ask us for help there. All those things available absolutely free. Let's go back to the phones and Issaquah, where we find Alan. Hi, Alan.
Hey, how are you?
I'm doing just great. How can we help you today?
So I have been investing in my 401k, and historically I've been pretty risk averse. So I've been putting all of my contributions into the Vanguard Wellington Fund, and that's done okay. Over time, of course, not as much as the S&P 500. And recently, I was having a conversation with a couple of buddies of mine, and they've done exceptionally well. And have said, the Vanguard Fund doesn't hold as many equities, and perhaps diversification might be better for you since you're 15 years out from retirement. So I thought I'd give you a call and pick your brain, see what your thoughts are.
Okay, well, a couple of things. First of all, the Vanguard Wellington Fund is a balanced fund. It is about 60% in stocks, 40% in fixed income. So the first thing I would do, Alan, would be to determine, what do I want my target allocation to be? In other words, you said you're 15 years from retirement. Okay, that's meaningful in one way, that you may need some of this money in 15 years. In another, it really isn't, because what people need to know about themselves is, what are their emotions around money? And because that helps you decide how much risk to take. So if you said, for example, well, I'm 15 years, I'm not going to use the money for another 5 years. That's 20 years. Okay, maybe you should have more risk in your portfolio. Let's just say, for sake of argument, 80% in stocks and 20% in bonds. That's just a suggestion. So you could take the risk quiz and help yourself understand that. That'd be part one. Part two is Wellington is only in large U.S. companies. You heard what I just talked to Joe about. You're missing out on so many other opportunities. All the other things that we mentioned. Small companies in the United States, small value companies in the United States, international stocks, which have decades of outperformance in your lifetime, 2000 through 2009. If you hadn't had international, you basically lost money. If you had international, you made 5 or 6% a year. So you're missing out on all those opportunities, both big companies there and small ones and growth ones and value ones and emerging markets, which really have been, frankly, the best performing market going back, I think, 50 plus years. Riskier companies, crummy countries, right, that look bad from day to day. And by the way, the United States was America was one of those emerging markets not that long ago, like 150 years ago. So you want to own all those things. Wellington doesn't do that. But the third strike I have against Wellington is it's an actively managed fund. Now, Vanguard has a very fine balanced index fund. So if you said, man, I kind of like being just in the U.S., and I really kind of want to have a balance between stocks and bonds, I would prefer and see you own the Vanguard Balanced Index Fund instead of Wellington. Wellington's been on their list for a very long time. It's a very old fund, but it would not be a one fund choice I would have for all the reasons I just mentioned. Alan, you still there?
Exposure.
I'm sorry. Keep going.
I am. Yeah. Would you recommend that maybe I pick like a diversified ETF, like a VTI, like a total market to get that small cap exposure you were talking about? Okay.
Yeah, exactly. Because that's going to give you, you're going to have, exposure is the exact right word. Your money is going to be invested in thousands of securities, not just a few hundred. Wellington has somebody there picking what they believe will be the best. I'm not smart enough to know that. They're not smart enough to know that. And all the research shows that people that appear to be smart enough to know that don't do it for very long. They kind of have a run and then they don't. Yeah. So, I think your buddies are correct. But the first thing I would do if I were you would be, again, take the risk quiz or really do some planning work to say, look, I need to end up with this number. That is a roughly number, and I'm willing to contribute this much, right? And if I make 6 or 7% a year, it works. Therefore, my portfolio should look like this because that's what it's done historically. That's how I think people should build portfolios rather than their buddy saying, hey, you're missing out on a lot of opportunity here, because there's always a lot of opportunity. I've missed out on opportunities too, but my portfolio is designed with me in mind, me and my wife, not what the world thinks is the right place to go.
Yeah, that's good advice. I'll start with that quiz. I appreciate it. Thank you.
Thank you, Alan. And by the way, we have had some trouble with the risk quiz lately, but we were on the phone with the people that we don't operate the risk quiz. We use a company that wrote the software, obviously, and it's available. We make it available. We pay for it so you can get it free, but go try it. Risk at talkingrealmoney.com. Click on risk quiz. It's free. It's all of one of the many services that we offer at Talking Real Money because we want you to feel good about money. We want you not to worry about things so much. So there's a couple of things I mentioned that you can always go there and ask us a question, right? That go to talkingrealmoney.com, click on contact us. You can type a question. You can say one into your computer. Don will answer later. If you want more individual help, which many of you find out is very helpful. We look at portfolios absolutely 100% free, no cost obligation, no sales pitch. You send us your stuff, right? Your statements, etc. We help you understand how diversified you are, how much risk you're taking, how much you're paying others. Really, if you have the proper balance in the portfolio, which we just talked to Alan, and I'd like to see some of those other types of stocks in there, right? Because historically, that's given you additional return. So for that kind of help, you just go to talkingrealmoney.com, click on Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.